Did you know you might be overpaying taxes by up to 30% when paying yourself from your UK business? Or does it feel like HMRC has a direct debit setup with your UK business every time you try and pay yourself out of your UK business? If so, it's time to change that, because today I will be revealing different methods how you can pay yourself from a UK business without paying significant amounts in taxes to the tax authorities. So if you want to keep more of your hard-earned cash in your pocket, you're in the right place. Hi everybody, I am Fizan. I am an auditor, accountant, turned entrepreneur, and I'm the founder of Innovative Consulting, where we help businesses grow, be more efficient, and save on taxes. Right, so what's the most tax efficient way to pay yourself from your UK business? Well, it's not as straightforward to give it a this or a that answer, but I'm going to share some ideas with you so you can discuss them with your accountants, because a lot of accountants these days, they're not bothered to share these ideas and insights with the business owners as they're usually on the snooze mode. So we'll first understand broadly how you can pay yourself from your UK business, and then I'm going to show you a hypothetical example with numbers to show you some tips and tricks that you can use to get money out of your UK business in the most tax efficient way. Okay, so let's start with the most straightforward option, which is paying yourself a salary. It's easy, it's straightforward, you know what you're getting, you're subject to income tax, you're subject to national insurance contributions. It's a predictable option, but remember, it's an option which is going to leave the least amount of cash in your pocket. It does come with a benefit, as the first £12,570 are tax free. So here are the tax rates and tax bands for the current year, where you can clearly see the first £12,570 are tax-free. Then if you're earning up to £5,270, this is basically your happy hour tax rate. It's affordable and it feels like a good deal. It's 20%. Then if you're earning up to £125,000 a year, you get taxed at 40%. It's like a premium cocktail tax rate. Then the next one, if you're really earning a lot of money and if you're bagging in a lot of cash, you get taxed at 45% if you're earning above £125,000 a year. It's so high that you have to think about having a new hobby called tax planning. So next up, you've got dividends. That's where the magic happens. If your company has made profits, you can distribute those profits to yourself in the form of dividends. Now, what's the great news? Dividends are taxed differently than salaries. You don't have to worry about paying any national insurance contributions, and the tax rates are much friendlier compared to when you pay yourself a salary. Now, the first £1,000 of dividends are tax-free. It's also called your dividend allowance, but remember, you can only pay yourself dividends if your company has made profits during the year. The rate of tax on dividends received will depend on the individual's income tax bracket, but remember, dividends will always be taxed on a lower rate compared to what you get taxed on salaries. Now, here's a little comparison of dividends versus salaries. Now, clearly you can see in the basic rate tax band, it's 20% on salary versus 8.75% on dividends. It's a lot of difference. Then if you look at the higher rate band, again, it's 40% on salaries versus 33.75% on dividends. And then even in the additional tax rate band, you get taxed at 45% if you're paying yourself a salary versus 39.35% on dividends. So clearly, paying yourself a dividend from your business is clearly a winner compared to paying yourself a salary, provided your business is making profits. So next up is pension contributions. So if you're thinking about your future, pension contributions are a great way to take money out from your business. Contributions to pension schemes are also tax deductible, meaning your corporate tax bill will be reduced, as these contributions are an allowable tax deductions. And not just that, money in a pension scheme basically grows tax-free, and then when you retire and get access to those pension schemes, it gets taxed at a significantly lower amount. Now, check out this video if you're interested to learn more about how you can use pension contributions to significantly lower your tax. It's a long game, but if you're planning about your future, it's a very solid option. Now, next is director's loan, which is essentially borrowing from your own business. Now, using short-term director's loan is a great way to get access to that much needed cash for your immediate financial needs without incurring any additional income tax. So if you want to get access to cash and don't want to go down the route of paying yourself a salary or paying yourself a dividend, I think director's loan is a great option that you can utilize, but it comes with its own rules. Now, when it comes to director's loan, there are two critical things that you have to be aware of. First is you have to make sure that you repay that loan within 9 months of the end of the financial year when you took out that loan, because if not, 32.5% tax is waiting for you. Then secondly, you cannot exceed £10,000. If you do, it will be counted as benefit in kind, and again, it means more tax. So overall, I think director's loan is a great option that you can utilize. It's a flexible option, but you have to be careful around the rules if you want to avoid unexpected tax bills. Right, so next is about employing your spouse in your business, which is the most interesting option amongst all other options that we discussed earlier. Now, did you know you could save about 27% on taxes just by employing your spouse in your business? Here's the hack. You can pay your spouse for the work they do for your business in various tax efficient ways. It works like a double-edged sword, to be honest, because of course, if you pay them a salary, it's a tax deductible business expense, and it helps you reduce your corporate tax bill. Now remember, I discussed about that £12,570 personal allowance, which is basically tax free. That's available to your spouse as well if you employ them in your business. Then in addition to that, do you also remember the £1,000 dividend allowance that we discussed, which is tax free? That is also available to your spouse if they are a director in your company and if you pay them dividends. So if you utilize these two options, you're basically doubling down on your allowances and you're doubling down on your take-home household income. Just make sure the salary you pay them is reasonable and in line with the work they do, because remember, HMRC is always on the look for something that's too good to be true. So there you have it. It was a quick guide of how you can pay yourself from your UK business in the most tax efficient manner, be it in the form of salaries or dividends or pension contributions, or by employing your spouse. So there are plenty of strategies that you can use to keep more of your hard-earned money in your pocket and keep the taxman away. Always remember, it's not about how much you earn, it's actually about how much you get to keep in your bank. Okay, so let me explain this to you in a quick hypothetical example. So hypothetically, there is this business owner which is in the business of carpet manufacturing, and he's let's say the payout is £100,000 a year. So we've divided this into 3 separate scenarios, and we're going to discuss each scenario. We're going to skim over each scenario quickly. So scenario 1 is payout 100,000. Business owner is paying 100,000 to himself in the form of salary. Now, as we discussed earlier, £12,570 are tax free. So then next, and net taxable income gets to £87,000, and then based on the slabs, the tax gets deducted, and then net payout gets to £72,000. Also, NIC is due as well. So after NIC deductions, the take-home amount gets to £68,000. Now in scenario 2, the same business owner introduces his spouse in the picture. Now, what they do is they divide, the payout is still £100,000 for this example. So what they do is they divide that £100,000 between each other, and what they do is they pay each other. No, they don't pay each other. The business pay both of them in the form of salaries. Now, remember I told you earlier the spouse gets access to the personal allowance as well. So you can see that in this case, 12,570 gets deducted from both of their salaries, and then the net taxable income gets to £37,000 each. Now, of course, because they've divided that £100,000 between, like, you know, in 2 equal chunks of £50,000, they don't exceed the 40% threshold, and therefore they're getting taxed at 20%. Now the tax due for both of them is £7,400, and net payout gets to £42,000 each. Of course, they'll have to pay national insurance contributions, and after that their take-home pay gets to £39,000 each. Cumulatively, £79,000 take-home compared to £68,000 when the business owner was paying himself £100,000 salary. Clearly a saving of about £11,000 already. Now what they do is, what the business owner does is he now gets get to pay dividend instead of salary. So what they do is they use the £12,570 of personal allowance first, and then pay the rest of the amount as dividends between the spouse and the business owner. So if you look at this, again, payout remains the same, £100,000. Third scenario, both of them get to have access to £12,570 of personal allowance. And then remember I told you the spouse gets access to the business, to the dividend allowance of £500 as well, like the business owner. So clearly you can see that has been deducted here, and then you know, their dividend income gets to £36,930 each. Now remember, previously we discussed the tax rates on dividends is always lower than if you get taxed on your salary. So if you see here, given the fall in the basic tax band, the tax rate is 8.75% instead of 20% in case of salary. So tax on dividends is 3231, and if you recall, I told you that there is no NIC contributions on dividend income, so we won't deduct any NIC contributions. So therefore, total tax that gets applied to both of them is £3,200, and take home, cumulative take home amount gets to £93,000. How massive is that? If you found this video helpful, please do give it a thumbs up. Do subscribe to this channel for more tips and tricks on how you can make the most of your business income. Do leave a comment below, and do let us know how do you plan to pay yourself this year. Take care for now, and see you until the next one. Bye.